Good morning, everybody, and welcome. We're broadcasting our 30-minute MarketCast III live from the AF Oliver offices in the middle of Bournemouth. And there are points during this office where you can actually see the sea. I promise you. For those that have visited, I'm sure you'd know that. Now, before I start into the MarketCast proper, on a day when we've heard that a great number of British butterflies are actually under threat of extinction, I'm wearing the butterfly shirt. The poll was quite clear and adamant on LinkedIn that you'd rather see the butterflies than the stripes. So there it is, there's the butterfly shirt. I have to tell you, full disclosure here, I have brought a change of clothes with me so that when I finish this MarketCast, I'm not intending to spend the rest of the day in the office with this shirt on, but we'll see. We'll see. Okay, this could be one of the most important MarketCasts we'll do in many a long March. There's an awful lot going on. I characterize this as a market holding its breath. We all know that things are going to change. What we don't know is by how much, how quickly, and when that's going to start. So my task this morning over the next 28 minutes or so is to try and explore all the drivers that are actually making those things happen, the dynamics behind them, so that when we come out of the other end of this, that we've got a really good idea. We can make an absolutely informed estimate of when that's going to be. Let's take a little look at the goods and the bads, the way that I generally tend to kick these things off, and we'll start with our reasons to be cheerful. Well, guess what? Rightmove came out this week, didn't it? I'm sure you've all seen the May Rightmove index, and it's records everywhere. They've announced a new look. It's all very smart. We'll come to that later. I'm going to give that index a little bit more time this morning on two counts. Number one, it's brand new data, from a very, very wide data set, of course. Number two, they've got a new look, so we'll have a little look at that. But it reaches this month 10.2% annual growth and hits record highs in prices and record lows in the amount of time it's taking to sell properties. We are still in this world right now where properties come onto the market and they are gone in moments, good properties. So we're going to explore just exactly why that is. But looking at our reasons to be cheerful, the average days to sell, according to Rightmove, have now fallen to 31. That's the average days to sell. So that includes all the pups that are out there that nobody wants. Quite incredible. Demand is still there. It's still robust. Despite all the prevailing headwinds that we're moving into, demand is still robust and supply is still incredibly limited. If you look at mortgage approvals, they fell again this month. We'll come back to that in a little more detail as I run through the front end of this presentation. But right now, mortgage approvals are still ahead of that 5-year very steady period that we had from 2014 up to COVID at the end of 2019. Unemployment hits a 50-year low. This is really, really important. And I actually think this is one of the secrets behind the divergence of the general economy and the housing market. And this picture that creates, if you like, a two-tier economy where people that are in work and sought after are much less affected right now by the economic headwinds that we've actually got out there. But of course, that eventually has to change. But that piece of data is really very important indeed. Vacancies are outnumbering job seekers right now, and that really is a very, very rare thing indeed. On the concern side, well, how many of these do you want? I've stuck a few on here just to get us started. The war in Ukraine shows no signs of coming to a close anytime soon, and that obviously has a spin-on effect right across the economy. With the effect it has on energy prices and how it's affecting food supplies and so on. So that's a really big issue that sits there off to one side. Inflation, well, 7.8%. That's the CPIH. So that's the consumer price index with the home makers costs in there as well, so mortgage cost and what have you included, hits the 30-year high. We all know energy costs are soaring. The new increase in cap was headlined yesterday, so come October, we're going to see a further increase in the energy price cap, average bills going up possibly to around £2,500 a year, and food costs following them up close behind. The consumer confidence in the UK, well, do you know what? I'm not even going to talk about that at the moment, because that's a really big deal when we're in the middle of this presentation. And I think any of you that have followed my property forecasts down the years know how much store I put in the consumer confidence barometer as a forerunner, as a bellwether for the way that the property market's going to move. So we will be coming to that a little bit later on in the presentation. And interest rates, of course, they can't be ignored. So they're still at pretty much historical lows. We'll touch on that, and we'll just take a look at where those rates are right now and how they're moving. But they are moving inexorably up as the government tries to cope with the way that inflation is running. Price to earnings ratio, still very, very high in London particularly, moving up towards that 7 times earnings level, which has to be a concern when we've got interest rates running as well. So there we go. There's our background. That's what we're facing. Let's try and put that into some sort of order and add some detail in so that we actually look at the way that the market's going to move over the next 6 months. The nationwide, we're due the new nationwide numbers any minute, so this really is pretty old now. These are the April numbers that came out 4 weeks ago, and as you can see there, a slight slowdown in the nationwide. So they've got their inflation dropping from annual average inflation dropping from 14.3 down to 12.1%. That is important. The nationwide is an important and well-respected index and is widely reported in the press. Right now, we're doing what this may sound clumsy and sledgehammer-like, but one of the little things that I'm doing right now is I'm getting somebody to count for me the amount of times the phrase property crash or the word crash appears in the national press. And that's a chart all on its own, the way that that is actually climbing as it starts to become a possibility. Indices like the nationwide are really important. The press, the mainstream media really like it. They give it a lot of respect and credibility, so it gets widely reported. And you can see there's quite a substantial drop in those April numbers. Halifax, which is a little way behind the nationwide, these again are April numbers, so these are due to be replaced fairly shortly, but you can see that the Halifax sits at 10.8% annual change. If you actually take that, if you take the Zoopla numbers, which is that wonderful merge of sold prices, prices agreed and mortgage approval and asking prices, that blend of all those prices, and they sit at 8 and a bit%. And then you go through the Halifax numbers at 10.8, your Rightmove at 10.2. We know, don't we, between those indices, we're running at just over 10% average inflation across the UK. I don't include the ONS numbers in that for the simple reason, pure and simple reason, that they're just so far out of date. They've only just now published the March numbers, and here we are coming into June. But they reflect exactly the same picture. So we can be pretty confident about those numbers. And as you know, this is one of my favorite of the nationwide data set. This is one of my favorite pieces of information because this gives us that 3 month on 3 month picture, taking some of the peaks and troughs out, excepting the COVID troughs, of course. And if I paint my arrow, which gets slightly more distorted every time I do this presentation, you can see where we're headed with the tail off on the nationwide numbers on that last month. And for me, this says all about reaching the peak on this current market. I'm absolutely convinced that's where we are. Stake my reputation on it. And I think now we will start to see these indices that we've got right across the board peaking now. They'll have reached either their height this month or maybe next. Then we're going to plateau, and then I think we're going to start to see an easing. But we'll come to that in more detail. The price to earnings ratio, I do think it's important to actually flag this up. It is climbing so very, very fast. And of course, combine that with interest rates, and that really then does create a huge double whammy. Thank Ben showing me there, 10 minutes gone already. How can that possibly be? I've stuck this Zoopla, I've moved this Zoopla slide a little bit further up the presentation because they split the price to earnings ratio down by region. And I think that's really important too, particularly when we're looking at more localized markets. And if you see, here are the earnings ratios here. And if we take the nationwide average at about 7 times earnings, which runs through here, it shows you here that Scotland, Northern region and Wales all sit below that median line with the Midlands, with Southern and London sitting well above it. And you can see here that at one point, London almost touched 12% earnings, but that market has moved back slightly over the last 2 years, as we know. That gives you a sense. I also wanted to devote just a few seconds to this survey. There's always something good in the nationwide report and index each month when it comes out. There are some nuggets to be found in there, and this was in their April report. They had a firm called Censuswide, you can see what they did with the name there, actually talked to just over 3,000 adults in the UK with no specific socioeconomic breakdown. They just called it adults above 16. And asked them a whole range of questions about their property intentions. This one I found absolutely incredible. So in here, these are the percentage of people that they questioned, of 3,000 people across the UK who are either considering moving or who are actually moving. And it's actually a shocking number. It is really a shocking number. It's 38% on average either moving or considering moving right now. That's a really big number, particularly when we think what's going on. And that number touches almost 50% in London too. What's amazing about that is if you have a little think about it and you say that on average each year, around 5% of the total UK housing stock changes hands, well, then that gives you some idea of just how big a number that actually is. Really fascinating. It's worth taking a look if you get the chance to go online and have a look at the April nationwide index, because they go into this in a lot more detail. I've stripped out 2 or 3 other slides I was going to show you on this just because there isn't time to do it. But it is really interesting. The one slide that I did put in was how this changes, if you have a look at this, how this changes by their current tenure, by their current situation. So these people, those who privately rent, you can see that their thinking of moving is up really, really close there to 50%. And it shows here, it compares it with the survey from the year before, last April is the red dot. So you can see how that's increased. So even though we had that extraordinary activity going on in the property market in 2021, the intention to move, the desire to move has increased even from there over the last 12 months. That just gives you some idea what's driving, that this is the industrial wheels that sit behind this property market that we've got at the moment, because you've got a nation in that sort of mood. They're incredible numbers. I really think they're very, very big numbers indeed. It's a canary moment, and I know that we all wait for this. The poor old canary. I should name him, really, shouldn't I? I should name him. I will. Claude. You've always got to alliterate with the name of animals, don't you? The technical team giving me looks here and wondering why on earth I'm going down the canary naming route. The first bit of canary data, and just for those of you that haven't seen this MarketCast before, what I clarify as canary data is information that gives us a real definite indication of how things are going to be a little way ahead in the future. This one for me is mortgage approvals. The combination in the UK market of both the way that prices are moving and the way that the numbers of transactions are moving is really important, particularly so when we're in a position of undersupply. Because of course the way those property market prices are being reported is a tiny proportion of transactions that are actually happening at any one time. So when these volumes start to get smaller, the potential for the market to flip becomes ever more extreme. So these are the very latest numbers, UK mortgage approvals. These are the April numbers, the March numbers rather, and you can see that they sit there at just over 70,000, almost 71,000. Here are the mortgage approvals there in that light blue line for house purchase, and you can see how that has dipped down from the return from COVID peak, and with all the effect of the stamp duty holiday and everything else. But here's a really interesting slide to show you. The important thing to say just before I move on from this is that although that is a very slight fall from the February numbers, just by a few hundred actually, it's still a good way ahead. It's some 7 or 8% ahead of that average 66,000 mortgage approvals that we had pretty much year on year from 2014 to 2019. But this is a great piece of work by a super company called Built Place. This is a company who provide fantastic data. I follow a lot of what they do, and they have just beautifully matched the mortgage approvals number against the HMRC total transactions number. That's really helpful for us. As you can see, mortgage approvals generally speaking, don't hold me to this for a few either way, but mortgages approvals generally represent about 2/3 of completions. And you can see how mortgage approvals obviously run ahead, because once the mortgage gets approved, the deal's got to get done. So it's, if you like, it's the little crystal ball for how the completions are going to go. Just take a look at this chart, because this is really important. Here come mortgage approvals then from the point where we had, here's March 2020 here in this dip. We come out of COVID, we have the stamp duty incentives, and since then mortgage approvals have been falling back towards their more established level back here, 2014, 2019. Here's been the crazy number of completions. The reason all those peaks and troughs are in there is because this was the stamp duty holiday, and then the extension of the stamp duty holiday, and then the introduction of the stamp duty taper. And that's what produced all of this crazy noise here. But you can see where mortgage approvals are going, and you can see at the moment where general completions are going. So these two lines have to stay together. Take a look back here. Take a look there. In the last 12, 13 years, they stay together, those lines. They may occasionally move apart if there is a big stamp duty incentive. That one back there, I think, was the introduction of the 3% for second homes from memory. But although they occasionally move apart, in the wise words of Al Green, it's very much a question of let's stay together. And if this line is coming down here, well, then this blue line is sure to follow it, as little Bo Peep and her sheep do. Interest rates then. Quick look at interest rates. I won't dwell on this because these are quite old numbers. New numbers should be coming out at the end of this month. But you can see here over on this chart over here, which is our 2-year fixed rate chart. So these are different loans to value, all of these over 2 years. And you can see from the very lowest loan to value up here, so this runs, as you can see from here, to 60% loan to value, all the way up to 95% loan to value. And you can see where the fixed rates have moved for 2-year money. And then over here, all of these are 75%. And the variation in these is the length of the loan, length of the mortgage. And that goes from the 10-year money here, sitting at around 2.5% for a 75%. Even the short-term money down here. So even the 2-year and the 3-year money has climbed up over 2%. There is no doubt where that's going, is there? You don't need to be a genius to know where interest rates are headed. And we know, don't we, all of us, what effect that eventually has on the market. So that's really important to us too. Such an important number. Inflation, I only put the chart up really because I've said to you already it's running at 7.8%. Just thought it was worth putting the chart up so that you can get a really graphic indication of just how rapidly that inflation has climbed. This is another reason why there's a dichotomy between the general economy and the housing market. You know, the people that are in the target audience for the developers, the people that are generally buying properties are those in the economy that are the least and last to be affected by these changes, by these economic headwinds. It will come, but it happens to them later in the economic cycle, and you can see here. So this started 2021 as we came back out of lockdown, and you can just see that it's been an inexorable climb. That has to have an effect. Another canary slide, and this is the one that I mentioned earlier on. This one really does bear some looking at. This is a most extraordinary slide, and let me tell you that GfK, they actually acquired I say many years ago, 20 years ago or so, I think, National Opinion Polls, NOP. So the NOP GfK Consumer Confidence Barometer has actually been going since 1974. So that's nearly 50 years. This overall index score here, that red line, is actually the worst it has ever been since they've been publishing these numbers. And that's most extraordinary. So I put this quote in here from a guy called Joe Staton, who's the Client Strategy Director of GfK. And he talks about this number, about this overall consumer confidence number, and he says, this means that consumer confidence is now weaker than in the darkest days of the global banking crisis, the impact of Brexit on the economy, or the COVID slowdown. Here it sits, look, minus 40. That's the lowest it has ever been since they've been publishing the data. Look at the other stats too. One surprising stat was a slight uptick in people's view of their own personal finances. And I always find that interesting, how we believe that although the economy is going to hell in a handcart and it's a bad time to make a major purchase and so on, we think that we're going to do okay. And we still do. There was actually in how we feel our personal finances are going to go, although we're still deep in negative, there was actually a tiny little uptick through there. Just so as you're aware how this chart works, and apologies to those of you who've seen it many times before, the red line through the middle is 0. People that say, I think things are going to be better in the next 12 months, give you a tick above the line. People that say they think it's going to be worse is a tick below the line. So of the 2,000 people that they survey to actually get these results, if all 2,000 had said we think it's going to get worse, it would be minus 100. And you can see, when it comes to that blue line and how the UK economy is going to fare over the next 12 months, wow. We know that consumer confidence is a massive constituent part to sentiment when it comes to buying houses. We know how important it is. I've been following these numbers for over 20 years. I've got presentations that I did using these numbers just before the 06, 07, 08 downturn, and they bear a remarkable similarity. I'm going to use the word crash again for the second time during this market cast this morning, but only to say that despite this, I still don't think it's a crash coming. I think it's a slowdown. And I think that the employment market has got much to do with that. But what this does say is that change is inevitable. For me now, this is absolutely nailed on. And the change in attitude and the change in the rate of inflation is going to come down this year. There is no question. I still think we'll end up the year in positive growth, but believe you me, it'll be a lot lower than it is at the moment. We've not got too much time to do too much on the RICS. I do think there are some important things to say in here. The new survey, the May survey, comes out on June the 9th, but for the April survey, just the canary slides in particular here, this is where it sits. Look at this. Do you remember I said at the start of this market cast This is a market holding its breath. Look at this. So these here are the agents saying, did you get more newly agreed sales over the past month? And this is their April survey. I'm told I've only got 5 minutes left. Where has that gone? But you can see here, those above the line think they did more, below the line think they did fewer. That's so even all the way through. That's on newly agreed sales here. This is the really important number. This is on new vendor instructions. So I am going to dash through the RICS survey just because I'm so short on time. But you can see here, these are new buyer inquiries looking generally positive pretty much across all regions. Don't know what on earth Wales seems to be in a negative place, but these are the stocks per surveyor, and this is where there is a tiny little bit of hope. Can you see that tiny uptick on the end there? I worry enormously about the very, very low stocks that the agents have currently got, and the potential for that to lead to a market stagnation, which would accentuate any major changes in the way that the market moves. In terms of the surveyors and how they think prices are going to go, that's a really important stat. And you can see over here, the azure blue line there is how the surveyors feel prices will move in the next 12 months. That's the balance, thinking they'll go up. You can see it's still well in positive, but come down from this peak. And here's how they feel that prices are going to move in the next 3 months. And again, they're in positive, but they are moving south all the time. And in terms of regional price expectations, well, it's only the guys in the East Midlands that feel negative. Everybody else still feels there's growth in the market. A quick look at the Halifax. These are brand new the Rightmove, sorry, numbers. These are brand new for May and a brand new look from Rightmove as well. You can see it's a new record here, 367k average asking price. And look at this. This is a record low average time for sellers to find a buyer. That means that overall the national asking price on Rightmove gets us to 10.2%. And just have a look here. So the first time buyers then across that time have seen 8% increase, and you can see then second steppers and top of the ladder at 11%. A fourth new record. The records keep going, don't they, on the Rightmove numbers, even with their new look. I think that's probably the last we'll see of them. We'll see. Next month, we'll see. The affordability, I think this is a really, really good piece of data, good piece of work. Have a look. I haven't got time to go into it now this morning. Well worth going onto the website to have a look at the affordability and the big change in affordability between first-time buyers buying and renting. And we've just actually seen those lines cross over again as well with the increases in interest rates and so on. So buying has just actually got, on average, a bit more expensive than renting. Here, according to Rightmove, is where the average asking price has gone on an annual basis. Here's where it's gone on the 5-year trend. And look at this. Here's the average time to sell come all the way down to 31 days. I'm absolutely amazed at that. But again, I think that's as low as that is going to go. And you can see here then on a month by month, the average change in asking prices. Sorry, I haven't got more time to dwell on that. That is well worth going and drilling in a bit further to and having a look. The recording of this will be going online in the next day or two, and that will give you a chance to perhaps have a slightly longer look at some of these important data. Here's Rightmove's average stock per agent, and interestingly, having come all the way down to an average of 40 in January, it's just gently starting to climb and has reached 44. Pretty much all in the green, apart from the northeast, and that's the Rightmove. So green means inflation or positive inflation. Blue there is neutral, nobody in negative inflation. So we've almost got a clean sweep across the UK for their May numbers. Zoopla are still working off their March numbers. Their April numbers are due out very, very soon. And as I said earlier on there, sat at 8.3% annual inflation. And there's their city index with only Aberdeen in negative inflation and Liverpool right up at the top there at 10.1%. Okay, so on to the takeouts as we rush through. So there is no question that we're seeing the volume of sales in the UK return back to where they were before, and I think that's where we're going to settle. I think that we're going to settle down at around about 100,000 transactions a month. But in the meantime, that impetus that we still had in that classic, well, what Rightmove called, I've just been told that's my 30 minutes up. So what Rightmove called the spring frenzy will take us up to about 1.3 million transactions for the year. Inflation, the rate of inflation will slow before the year end. There is no question about that. I still think it is going to be in positive territory just because so much of the transactions, or so many of the transactions that we're going to see through late spring into summer are already done. They're already in the bag. And the market, ask the agents. If you go and read the comments on the RICS survey, it's incredible when you read what some of these agents are saying. You know, it's a race to get to a property that actually comes on the market because so many people want to buy it. And I think that underpins where we are, but it slows. It definitely slows, and I think it slows towards the end of summer. And a little bit like I said when we went through this situation where, although we're going to end the year in positive growth, the slowing down from very high positive growth to normal positive growth can be a painful experience. The analogy I used was if you're on a motorway in a car and you're doing 70 miles an hour and you have to brake down to 30 miles an hour in the space of 100 meters, although you're still moving forward, you can be pretty certain that everyone in your car has spilt their coffee. So just have a little thought about how that is going to feel, that rate of inflation coming down. Stocks remain at an all-time low. We're in danger of stagnation, of market stasis. And I think that lack of choice could be one of the things that really dictates the speed of the slowdown. So to encapsulate then what I've said, yes, we are going to see a slowdown. No, I do not think that that's going to happen until we get into mid-late summer. I think we're going to end the year at 6%. I'm sticking with that. It's what I said 3 months ago now, and I'm staying with that. I think that's where we're going to be. But the later we go into the year, before that slowdown and that normalization starts, the more violent that's going to feel. I think we'll learn a lot more stories for next month's MarketCast 4. I'll try and find myself a shirt that is equally dynamic. And hopefully we'll have some information that allows us to be perhaps a bit more precise in terms of timings and the extent of price movements. Sorry it's been such a gallop. At least it means you're ready now to go out and do a full day. And I shall look forward to seeing you in June for MarketCast 4. So it's goodbye from me, from AF Oliver here in Bournemouth, and thank you very much indeed for watching.